I like to compare the economy to a magic trick, which is weird because people think they're not the same, but they actually share the most important thing together, psychology. And here's what I mean. If I show you this deck of cards, which by the way is a completely ordinary deck of cards, I could, by shuffling it, make you think and condition you to believe that what I'm creating is complete chaos. Some cards are upside down and right side up, and this is the economy. And I can even prove it. So economists will look at this and they'll say, well, some cards are back to front and some of these are front to back, so I know what's gonna happen to the economy. But that was misdirection, because it shouldn't make sense that with one small move, I could take half the deck and just by reversing it, I could reverse the order back to normal. That does not make sense, and that's kind of how the economy works as well. For example, between the years 1996 to 2006, the real estate market conditioned people to believe that it could only go up forever. But then, with one move, the market crashed 30%. But because we love a good magic trick, it looks like it's kind of happening again, because between the years 2012 and 2022, real home growth appreciated by 4.5% per year for 10 straight years. So again, conditioning us to believe that the real estate market could only go up forever. But now it looks like we're about to find out how that magic trick was done again, which probably didn't make any sense, but I like that intro and I'm gonna keep it. All right, so this is going to be a fun one. So I was inspired to make my video after watching EPB Research's video on why home prices haven't crashed yet. And in that video, there's a couple things I learned that really blew my mind. Like the fact that home values will have a major correction, if not an outright crash soon, thanks to 3 leading economic indicators that prove it. But the crazier thing I learned is that how well real estate does determines how people spend their money with something called the wealth effect. And so far, it looks like the correction has already started. A typical house, for example, is now selling for less than the listing price for the first time in 17 months. And this spread of falling home prices is expected to reach over 184 cities by as much as 20% or more, and it's happening worldwide. Places like Canada, Australia, and New Zealand are expected to lose 13, 18, and 21% respectively in 2023, according to research put out by Goldman Sachs. And foreclosures are already up 219% in the first half of this year as compared to the same time last year. So strap in, this is gonna be a crazy video. We'll talk about where home values are most likely going, spoiler alert, they're not going up, and how these falling prices will affect what's called the wealth effect and how that will affect the recession. So with that said, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the wealth effect. But first, what is the wealth effect? The wealth effect is an economic theory that suggests people typically like to spend more of their money as the value of their assets go up. That's when people like to borrow against themselves. So here's what I mean. With my own stock portfolio, for example, I can do one of two things. I can either sell all of it to pay for my lifestyle or my retirement, or I could go to the bank and say, hey, Mr. Bank, you see this money? I've got money. Give me a loan. So they give me a loan at whatever interest rate. Now, as long as the interest rate of that bank loan is lower than the interest rate of what I expect to make from my portfolio, which is 8 to 10% per year, as long as it's lower, that means I'll end up making money. So this theory suggests that as someone's net worth goes up, people like to do this a lot more. So one Nobel Prize winning economist, Robert Shiller, decided to put this theory to the test. And he published a research paper, and at the end of it he said, believe it or not, there is very little correlation between how well the stock market does and its influence on the wealth effect. And that's probably because stocks are very volatile, right? They move up, they move down. People don't like to take that much risk with their portfolios. But he also said they found a very strong correlation between how well the real estate market does and the wealth effect. And this is beautifully explained by EPB Research's video. As home prices grow, consumers like to borrow against their house with something called a home equity loan. And a home equity loan is just a loan the bank gives you in one lump sum payment that you're then expected to pay back every single month. Now, your house basically becomes an ATM machine, which you can borrow against and then use it to pay for your lifestyle. And this strategy can keep on going indefinitely as long as the value of your house keeps on going up. You can take out another loan to pay off your other loans or spend the money on whatever you want. Now, it's not necessarily a safe strategy, but it is something that people do all the time. In fact, if you look at home equity on Google Trends over the last 20 years, you'll see that when real estate was going up, there were huge spikes of people Googling home equity. And that's because it is the ultimate infinite money glitch. But this strategy can also work against against you, because if the value of your house goes down, then this wealth effect could shrink your spending power. That's when banks get more defensive, they start to loan less money, and the effects of the recession get even worse because of a slowing down of what's called the capital velocity. Now, unfortunately, no one has a crystal ball that can predict the future of home values, but at least according to Moody's, which is a company that rates the safety of loans, says that 2/3 of the country's real estate is already overvalued. And I also learned that there are 3 leading economic indicators that have been very reliable in the past in predicting where future home values will be, which right now the data shows is not looking good. Let me show you. So here are the 3 leading economic indicators that show that home prices will have a major correction soon. And by the way, a leading economic indicator is just nerd for data that happens before prices start to move. And by themselves, these leading economic indicators don't predict future values. But that's why economists like to gather a bunch of these data points to get a general idea of where prices might be going. So again, credit to EPB Research for putting this together, but the first leading economic indicator is the monthly supply of homes. Now, all this does is it measures the supply of homes that are available on the market and how long that inventory would last, assuming no new homes would hit the market. So here's the graph so you can see exactly what's going on. The black line represents price growth and the green line represents a new monthly supply of homes. A couple things to understand. When the green line goes down, it means the supply goes up. It's inverted in this case so you can understand and see the correlation easier. And as inventory goes up, you can see that home values, which are represented by the black line, start to come down. And this makes perfect sense. As the market adds new homes, there's less competition for inventory, therefore prices go down. And the same is true in reverse. When there are less homes, there's more competition for every house, therefore prices go up. So let me show you some examples of how this leading economic indicator was able to reliably predict prices before. You can see in this example, before the 2007 drop, when the inventory went up, as represented by this green line going down, prices then followed. And then you can see it again in reverse during the 2013 and 14 price growth. Supply goes down first, and then prices go up. And then the same thing again in 2019. Now, if we look at what's going on today, here's what the monthly supply is telling us. There's a huge imbalance, and there's a lot more supply, and prices haven't really had the time to adjust and catch up, which implies that prices are about to correct. So that's the first leading economic indicator, the monthly supply of homes. But we can't just rely on one of them, so here's another one. Now, the second leading economic indicator is the spread on the mortgage rates and the treasury yields. This is going to sound insanely complicated, so you might have to watch this part a couple times, but let me show you what I mean. 30-year mortgage rates follow very closely what are called the 10-year treasuries. Now, treasuries is just a fancy word for saying bonds from the government, right? And that's a pretty much guaranteed way to make money. Now, if I'm a bank and the interest rate on the 10-year treasury, 10-year bond, is 3%, then if I want to loan my money to you, let's say, I would never loan my money at 3%, because with you, I'm taking on a risk, when instead I know I could park my money with the government and get a 3% guaranteed. So if I'm gonna risk my money, I'm going to make a little bit extra something for myself. So for you, I might offer you a 3.5%, maybe 4 or 4.5% rate, of course, depending on how risky I think you are and how risky I think the real estate market is. And normally in a healthy real estate market, the spread between what I offer you and what the government offers me is very close together. But the wider that gap is, the greater the risk in the market is. And the greater the risk, the higher the odds that the real estate market would fall, which makes sense because the greater the risk of something, the higher the odds that it would fail. I know that sounds insanely complicated, so let me show you the data and hopefully it'll make a little more sense. In this graph, the green line going down means a widening of the rate gap, which indicates more risk in the market. And this gap was able to predict a decline in home values in 2007. You can see as it widened, home values eventually started to go down. And it was also able to predict the recovery when the gap tightened in 2010. As the green line goes up, which indicated the market saw less risk, prices eventually followed upward as well. Now, if that sounded like a different language, trust me, you are not alone. I had to watch that video a couple times and even pause it, but here's what really helped me. That green line you saw in that chart is not mortgage rates, it is not bond interest rates, it is the relationship between the two.
And as the green line moves up, it means the gap tightens between interest rates on mortgages and bonds. But as the green line goes down, that rate gap widens, and that means more risk. Right now, though, there's a huge gap between mortgage rates and bond yields, which means, at least according to lenders, there's a massive amount of risk in the real estate market. And that means this black line should go down at some point. Now, how far down it's gonna go is the million-dollar question, and I have no idea, but you get the picture. Now, here's the third leading economic indicator, and luckily this one is way easier to understand. The third and last leading economic indicator is, I think, everyone's favorite, which is the M2 supply of money. When the economy is flooded with this M2, or the supply of money, it provides liquidity to the economy. So you can think of this as a concept kind of like watering a plant. The water in this case is money, and the plants are assets. And generally speaking, the more money or liquidity there is in the system, the better off all assets are. You can see in this chart right here where the green line represents the growth of the money supply. When there's an injection of money, home values go up. And this has been true during all of these periods highlighted in yellow. But right now, if we look at this M2 money supply, you'll see that this liquidity and all of this money has been taken out of the system. This is where we are now. And yet home prices are still all the way up here. They haven't had the time to catch up yet, but it typically takes anywhere between 6 to 18 months for the full effect to be felt. So all in all, here's what's going on. We have the monthly supply of homes going up, which means less competition amongst the buyers. It also means home builders will finally offer new incentives. We also have the spread between the mortgage rates and bond rates start to increase, which means that lenders are seeing more risk in the real estate market. And obviously what lenders think matters a lot because they have more data than the average consumer does. It also means banks could start to tighten lending requirements and maybe loan less money. And then of course we have less money in the system and less liquidity. Now, by themselves, none of these leading economic indicators can tell us the whole story, but together they're painting a pretty clear picture of where they think the market is going. Now, if you made it this far, let me give you my personal thoughts. Now, personally, I own my house here in Las Vegas and I bought another one to rent out. But even though I don't consider myself to be a real estate person, as I mostly invest in stocks and a little bit of crypto, real estate still represents the single biggest asset in my entire portfolio. And that also happens to be true for most households in the US. A house will probably be the single biggest investment we will ever make. So how well real estate does has a huge effect on how we feel about our net worth and therefore how we spend our money, which has a huge effect on how bad the recession can get. And this extends to all areas of the economy, not just consumer spending, but also how businesses spend their money so they could start cutting back. At the end of the day, I personally have no idea where home values will be in the future because I don't make my own predictions and I don't try to time the market. But if I was in the market to buy a house today, I would probably wait until the real estate market corrects, or at least until interest rates got down to 3.5% to 4.5%. It's not advice, it's just what I would do. Instead, what this video is mostly trying to say is that the more you understand what's going on, the less you'll hopefully let this psychology affect how you start investing. Because even if you could time the market top and sell everything to wait and buy back in, it would be doubly hard, if not impossible, to find that market bottom and start investing again. That's why I don't try to time it. I continue to dollar cost average and invest little by little at a time. I'd love to hear your thoughts, and as always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin with this link right here. Don't forget to move it offline. Grab the money while the money's still there. Grab your free stocks, links are all down below, and then go track them automatically with the spreadsheet linked down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon. Bye-bye.